Hi, good evening. Thank you for joining us today. And Probably we just wait for a minute more as our other attendees join the call, and soon after we'll kickstart. Thank you so much. So let me officially kickstart. Again, welcome everyone who has joined in. Thank you for joining the call. My colleague Hunting and I had published the ASEAN-6 Outlook Note for 2025 recently. And I think in today's discussion, we were hoping to bring forth some of the key takeaways from that report. When we released this report, that was hours before the US president inauguration, and we were quite mindful that in a few hours back then, there could be material changes on the trade and tariff front. But in the weeks since, we have been presented with a bit more cautious view from the incoming US president. And I think the focus is kind of shifting from pronouncements to implementation. And I think we will wait to see what more is in the pipeline. With this in mind, we delve into today's discussion. My colleague Hanteng will kick off, and I'll join in the second half. And before we get into the presentation proper, we wanted to share the QR code with you. Please do feel free to pose any questions that you might have on ASEAN-6 or general developments thereof, and we'll be happy to take them up after the presentation is done. On Hanteng, do you want to take it forward?
Sure. Thank you, Radhika, for the very nice introduction, and thank you everyone for joining us. So, just going into the outline proper, we'll cover firstly the 2025 growth momentum, what are our expectations and forecasts. Secondly, we'll touch upon intra-ASEAN linkages, a very important cushion for the region amid this geo-economic fragmentation that we are seeing. Thirdly, Radhika would then step in to talk about the tailwinds that we are seeing in terms of regional investment shifts. And lastly, we'll end off with the very important implications from the US side and what it means for the region. So just moving in, before we go into our ASEAN-6 2025 expectations and forecasts, I think it is good that we step back a bit and look at the economic conditions that we saw in 2024. And this kind of means what the region is entering 2025 with. And really, we'd like to look at it from 5 different perspectives. Firstly, from growth, inflation, policy interest rates, FX, and not forgetting politics. Firstly, when we look at growth, the global growth outlook has been quite resilient. And I think for ASEAN-6 in 2024, it has benefited from improved growth in 2024, and things are looking actually quite good entering into 2025. In terms of inflation and interest rate, I think these are two key challenges globally and including for the region over the past couple of years. And things are shifting for these two indicators. I think inflation globally is taking a step back closer towards target. Whereas I think for ASEAN-6, the inflation has been quite supply side driven in terms of the supply chain shocks and that to commodity prices, and being driven by highly driven by food and oil prices, and with those prices coming off, ASEAN-6 inflation has also come off quite nicely towards for most of the central banks, for most of the region, for most of the countries in the region, the inflation has come in within the target of the central banks. And therefore, I think with inflation coming off, globally, the easing cycle has started, especially the US Fed, which has started to cut interest rates from September last year. And in ASEAN-6, I think we are seeing a steady to lower interest rates with BI, BSP, and even Thailand cutting interest rates in 2024. FX-wise, I think there was quite a lot of volatility. I think especially after the US elections, we see US dollar strength, and that has translated to some weakness in ASEAN currencies. We'll touch on upon much more later on. And lastly, I think not just looking at geopolitics, I think we have to look at domestic politics in the region. And domestic politics has in fact been largely stable in the region in 2024. Indonesia witnessed election and a successful political change in leadership, while I think Singapore transited quite smoothly to the fourth generation leadership team led by Prime Minister Lawrence Wong. And I think in terms of political developments, 2025 would see Singapore go into general elections that are due by November of this year. So now going into our growth forecast. Firstly, we are expecting largely steady growth of 4.9% on aggregate for the region. And this really backed by still resilient real purchasing power as inflation recedes. Looser monetary policy, I think investment opportunities that are being created as brought about by some of these political shifts. By and large, I think 2024 has witnessed more upgrades in ASEAN-6 economic growth projections than downgrades, and trade has fared better and the investment outlook is positive. And I think there's some carry forward of this momentum for the ASEAN-6 region, at least in the first half of 2025. Now, I think one thing that's quite critical for the region is trade and electronics. One indicator that we really like to look at is our forward-looking proprietary export indicator, which provides a forward-looking view of the export dynamics or forecast in the next 3 months or so. And here, our forward-looking proprietary export indicator, leading indicator, is showing that trade, at least in early 2025, would still remain quite positive for EM Asia as well as ASEAN-6. I think one key reason for that is that the region would partly benefit from a front-loading of orders before some of these US-related tariffs are being imposed. And I think some of this data is really showing this strong momentum in terms of exports, whether it's from China or regionally, where we have seen quite strong trade numbers for countries like Malaysia and Singapore. And of course, I think the region is one where we have major electronics exporters, and electronics is quite a significant part of the exports mix, even if it might be diversified for some economies, for example, like Malaysia. But by and large, I think electronics is quite important and the cycle is quite important. And therefore, I think in 2024, what we have seen is a global tech upcycle as inventories are being rebuilt after the drawdown in 2023. And therefore, electronics exports in the region have turned around alongside the global tech upcycle. I think in 2025, there's still quite some momentum. And I think economies in this part of the region will continue to benefit from, say, the rising adoption of AI applications into some of these consumer devices and the refresh cycle that is ongoing for smartphones and PCs. Well, we look at trade that is doing well. I think FDI has also seen quite some traction over the past couple of years. The region has seen quite some increase in FDI inflows, catalyzed by the Trump 1.0 developments, as well as I think supply chain diversification and China Plus One effects post-pandemic, which I think Radhika will delve more into detail later on. The other part of the economy that I think is quite critical is in terms of private consumption. That accounts for 50 to 70% of the region's GDP. And here what we see is that private consumption have by and large hold out quite well in the post-pandemic era as labor markets remain quite resilient and inflation starts to ease. And this private consumption dynamic seems likely to sustain itself in 2025, even as we see some downside risk in terms of the trade dynamics, perhaps towards the second half of the year. Now, let me dive into one of the key themes that we have mentioned in our ASEAN outlook, which is intra-ASEAN linkages. I think one key aspect of the region is that ASEAN-6 has maintained quite close relationship intra-region, even if we see increased FDI trade linkages with China over the past decade. Here we see that the total trade of ASEAN-6 with China has increased, but what we also see is that intra-ASEAN goods trade share for ASEAN-6 continues to be the largest. In fact, at around 20%, and I think in value terms, it's around US 700 billion as of 2023. So we expect the intra-ASEAN goods trade to remain quite hefty. I think after all, we see quite strong trade cooperation that's supported by multilateral agreements, for example, such as the RCEP, which is, I think, first thought of by the ASEAN nations. And this will continue to drive, intra-ASEAN related trade. There's also support by ASEAN trade-related agreements. But we note that there's really quite high integration in already concentrated categories, such as electronics and mineral fuel-related products. These are the top two items that's traded in intra-ASEAN even prior to the pandemic, and we have seen their respective shares actually increase further from the periods before the pandemic and 2023, and together they account for 40 plus and almost close to 50% of total intra-ASEAN trade. I think this would be two key categories that will remain quite important for the region. So other than multilateral collaboration in terms of intra-ASEAN trade, I think there's quite a lot of progress in terms of bilateral initiatives. And I think one key one that really stands out at this point of time is the Johor-Singapore Special Economic Zone, where Singapore and Malaysia is collaborating on, and in fact is in their national agenda. And what we're seeing is that the Johor-Singapore Special Economic Zone agreement was formalized recently during the 11th Malaysia-Singapore leaders retreat on January 6 to 7, bringing forward plans on this economic hub. So I think the JSSEZ really aims to create a dynamic and integrated economic hub, and we know that Malaysia and Singapore has really quite close trade and investment and people-to-people ties. So what we have seen is that the JSSEZ agreement formalizes the sort of economic development and cooperation. And what we've seen here is it will occupy 3,571 square kilometers of land across southern Johor. And here I have this nice infographic from Channel News Asia, which shows that the SEZ will consist of 9 flagship zones, with each focusing on different activities. And to put this in context, the JSSEZ is about 4 times larger than the size of Singapore, and I think quite comparable to the size of Shenzhen and Hong Kong SAR, which is being seen by investors as something to be role model after. Now, the Johor-Singapore SEZ really tries to create and leverage on the strengths of both Singapore and Johor to create a dynamic economic hub to attract global investments. I think one key thing that Singapore is really good at is its highly ranked business competitiveness. And here I really like to use the IMD World Competitiveness Ranking, which shows that Singapore is in fact top in a number of categories, such as economic performance, government efficiency, business efficiency, and infrastructure. Although I must say that while Singapore does well on all these metrics, there's one particular matrix that Singapore perhaps falls slightly behind, which is its high prices and a high operating cost environment, which Johor can help with. Here, I think therefore Johor offers its complementary strengths as well. Johor is the second most populous state in Malaysia after Selangor, with a population of 4.1 billion in 2023. So not that far behind from Singapore, but I think critically it has a young population, and its population is projected to grow at a faster rate than Singapore, around 1% CAGR until 2035. And therefore, I think firms expanding into the SEZ can tap on the expanding workforce within the SEZ. And just now I mentioned that Singapore has a high operating cost environment, and particularly on the manpower front, given its tight labor market. I think therefore, with the median monthly wages that are lower in not only in Malaysia but in Johor, they are significantly lower than Singapore. Companies that are operating in the SEZ can leverage on this lower labor cost and therefore make their production more competitive. So that would allow firms not only on the labor cost side to benefit, but also in terms of land, as well as also I think energy resources, which Johor has abundant. Now let me touch on the SEZ agreement that was signed earlier in January. And here we see that the agreement really tries to set up the broad contours of the SEZ over the coming years, with details likely to be forthcoming over the coming months and quarters, as some of these issues between Johor and Singapore also has to take time to be resolved and rolled out. So the agreement basically builds on a MOU that was signed about a year ago, and various early initiatives that were rolled out throughout the course of 2024 with discussions between the governments and also taking businesses' feedback. Some of these early initiatives are, say, passport-free QR code clearance at the land checkpoints between Singapore and Malaysia. And this has been implemented since March 2024. And I think this would help with the movement of people across both sides. Secondly, I think there's an agenda to set up Invest Malaysia Facilitation Center Johor to help with the ease of doing business, including streamlining approvals. Thirdly, I think there's quite some partnerships and MOUs being signed to strengthen collaboration in technical and vocational education and training to ensure that there is sufficient and the building of skilled manpower to service the firms operating in the SEZ. And lastly, I think the other early initiatives is in terms of streamline custom procedures for land transshipments. And from January this year, there's a single transshipment permit for the Singapore Customs. So the four key areas of focus in the agreement continues to be economic cooperation, movement of people and goods, talent development, and ease of doing business. And really, just now we mentioned quite a lot of early initiatives. They will continue to do more. And in terms of economic cooperation, we've seen that there's 11 economic sectors that are being focused on that are really diverse, whether it's in manufacturing, logistics, tourism, renewable energy, or digital economy. I think one thing that is heartened is that there are goals being set in place in that over the first 5 years, they will try to promote and facilitate expansion of 50 projects, and within 10 years, 100 projects, and also creating 20,000 skilled job opportunities over the coming years. So this is my last slide on the SEZ, and I think that the SEZ is going to be a multi-year phase development and will take time to evolve. But I think global investors are really viewing Singapore and Malaysia quite well amidst heightened geopolitical and global economic uncertainty. And I think the leaders will continue to firmly commit to this SEZ and continue to work on the initiatives that investors are interested in. So I think 3 key areas to watch out for over the coming quarters would be that I think 2 countries during the leaders retreat has set up a commitment to have quarterly meetings between the 2 countries to work out some of the things that are important to the SEZ as well as for the 2 countries. So we are expected to hear more about developments on this front. Secondly, I think investors and myself will be looking for the harmonization of regulatory framework and processes. After all, it's 2 countries that are coming together to try to work on this SEZ, and there's a need to harmonize in terms of some of the regulatory framework and processes. For example, in terms of tax, how would the FTA agreements work in the SEZ? Thirdly, I think beyond 2025, we have the rapid transit system link between Johor Bahru and Singapore, 4 km between the Johor Bahru and Singapore, that will connect further from end 2026. And this would be a major catalyst for greater and smoother connectivity between Singapore and Johor. And I think this would, with the train journey estimated to be 5 to 6 minutes between stations, that would really improve the movement between Johor Bahru, and Singapore. And therefore, that will help to spur even greater trade and investment. So now let me pass on the time to Radhika.
Thank you so much, Hunting. And just to draw everybody's attention to the QR code, please do feel free to drop in questions, and any that is within our realm, we'll be happy to answer them. Thank you so much, Hunting, for also outlining very, very important points, especially the bit about ASEAN, within ASEAN integration, which is kind of good defense that the region puts up against its other, against other threats or uncertainties that lies ahead. So taking this forward, I want to just touch upon the tailwinds from the regional investment shifts, and I think much has been spoken about. Whether this region, how much is it benefiting, which parts are benefiting, and what kind of investments are coming in. We have had, if any of you have followed our publications, we have Hunting and myself and a couple of other colleagues have also been writing on this topic in the past 2 years. And very, very interesting observations to be made, which some of which we'll share here. In the next slide, what we want to show you is, is there any material benefit? Of course, there is this conversation going on flows are coming in, into this region, coming fast and thick. And we want to just highlight, is it actually showing in the numbers? And it is. If you see the chart on the right, for example, which is on the FDI inflows, that shows you that, while FDI into ASEAN has generally been going up in, say, from the past 6-7 years, you've seen a distinct increase, and it has come really, really fast, right? So you can see quite a steep climb in that part of the line. And we try and kind of draw in parallel with what's happening in China as well. Again, inflows into China have been also going up. Of late, interest there has tapered off a bit, but that is kind of offset with what's happening on the ASEAN side, which is still quite strong when we picked it up in the tail end of 23 and into 24 as well. Now, trade is, FDI is, of course, one part of the discussion. The other bit is trade. Trade between ASEAN, with China, with US, with Europe has also been, improving and going up. And one of the indicators we wanted to highlight here is for China itself, ASEAN has become a very important partner. And that is what the chart on the left shows, that the share of ASEAN-6 in China's own, client basket, or the countries that it sells to, has been steadily on the climb. In fact, the latest data that we picked up kind of shows that it's even moving, edging out US and Europe as a pre-trading partner. Now that again shows you that ASEAN-6 from an FDI front has also kind of been concurrently taking place in terms of stronger ties, stronger trade ties with China. So material benefits, yes, in terms of flows, we do see that in the numbers. Then comes the question, which again is a very important point, which is shown in the next slide, in terms of, where are the flows going? And this is a question that we get posed by, especially by clients, very actively. Each of them, depending on which part of the region that they look at, they be keen interest to see where bulk of the flow is going. And what we notice is that bulk of the inflows are actually coming into Singapore. A good part, we tried to draw a comparison between 2018 and 2023. And you can clearly see that the pie has only grown. Certainly, the quantum of flows have gone up, but more importantly, you've seen Singapore retain its share in the grander mix. Some other countries, of course, much has been spoken about Malaysia, and I think Hunting did draw up on the point that Singapore and Malaysia will be a part of Malaysia. Johor, particularly, will be, taking on the next phase once the SEZ is up and running, trying to grab a bigger share of the market. So in terms of 2018 to 2023, we've really seen flows coming to Singapore a lot more, but we've also seen a bigger share for Indonesia, for example. Vietnam has been broadly stable. Thailand has gone down a bit. Based on what we have captured. And when we see in terms of the quantum of flows, certainly again, going up, we saw a CAGR of about 10% in the year in the 7-8 years ending 2023. If we even assume a more modest 8% growth for the next 7-8 years to the end of this decade, we see that we could easily be close to about 350, 360 billion. So certainly much more optimistic in terms of the flows. And I think this has got to do with the strength that ASEAN-6 presents. We always do discuss the demographics. It's a young population, and it's where your labor is also available. But I think this is also not only the natural strengths, but also what the governments have done, which is to take advantage of this reconfiguration that is going on, and try and attract inflows. So you've seen governments actually go for tax holidays, provide basic factors of production, capital, land, all this in a much easier way, and try and lure inflows. And depending on whichever sector that each of these countries have strengths in. In the next slide, then we also tackle one more question, which is who is investing. If you could, yeah. So one point that comes up often in our discussion, and with say our clients, is that is it just one or two countries that really dominate the FDI investor base? Particularly, the question always comes up about China. Is it really dominating? Is it the main and the only region? And so we want to kind of debunk that myth. We do see, again, country on country basis, the share differs. But what you see generally is that a lot more US, European countries, US, Europe, you also see advanced Northeast Asia. So what we represent here is countries like Taiwan, South Korea, Japan, being quite important investors. And there could be a variety of industries, right? It could be everything from electronics to some of the services that they provide, some of the, say I would think for electronics industry, for example, the part of the industry called the ATMP, which is basically assembly, testing, and marking and packing. So that part of the business has also moved to some countries in this region. And interestingly, you also see an ASEAN country making its presence as a key investor, and that's Singapore. In fact, for one or two countries in amongst ASEAN-6, Singapore is the major investor as well. So quite a diverse mix. But I don't want to take away the fact that yes, China's share has gone up in the total FDI. In fact, if you compare prior to 2017, the share was quite smaller. We try and bring China and Hong Kong together here. And you can see that subsequent to 2018, the share of inflows have gone up. So certainly, China's inflows into the region, we can show it, you can cut this various ways, but there's no denying the fact that a lot of conversation used to be about how much money is going into China. Now a conversation is about how much money is coming out of China. So China itself being a key outbound investor into this region. So we kind of tackled, how much flows are coming in. Do you see that in the numbers? And who is investing? In the next bit, I want to just highlight three main points. First of all, take a bit of a granular look at some of the countries. We have chosen three countries here: Singapore, Vietnam, and Indonesia. And in Singapore's front, you can see, despite the fact, and some of Hunting's charts showed that cost of production, cost of operating a business is high in Singapore. But when you speak to some of the businesses, they will tell you that cost is only a part of the decision which influences their investments. Certainly, a lot more goes into it in terms of regulatory backdrop, legal backdrop, stability in general of the currency regime, so on and so forth. So Singapore still maintains, its allure for overseas manufacturers. So you've seen actually electronics manufacturing companies, even including chemicals, its share on its flows going up. You also see services actually picking up quite sharply. And this is a mix of services, and it goes beyond your BFSI, right? You see more, say, for example, e-commerce names coming in. You see more business services, as more companies from overseas come in, you also see the need for professional services, business services to support these businesses. So that is also another sector that has certainly gone up. So as much as manufacturing numbers have gone up, so have services. On the Vietnam front, of course, Vietnam maintains its major role as a manufacturing hub, bulk of which also gets exported. And we have continued to see that a bit of an increase also in the real estate bit. Of course, real estate in the economy is going into a bit of a churn. There were some high-profile scandals that had slowed down the sector a bit, but you still see it among the top attracting inflows. And then comes Indonesia, and we want to highlight Indonesia here because while you see electronics, manufacturing, chemicals go into other parts of the region, including Malaysia, for instance, Indonesia's case, it's still quite resource oriented, to mean natural resource oriented or commodity oriented. The government has made a very concerted effort in the past decade or so, much more in the past 5-6 years, to expand beyond just raw material exports. They've tried and they've brought in policies to move up the chain, go into downstreaming, and that has borne some success. In fact, if you see the difference between 2019 and the 3 quarters in 2024, you see that the share of secondary FDI going into secondary segments or sectors has gone up, and that comprises of base metal processing. Attempts to attract more investors there rather than just ship out nickel, ship out bauxite, ship out tin. They are looking to attract many more names onshore. And more recently, you have seen actually EV car manufacturers from China, for instance, also setting up base in Indonesia. And part of it is also because Indonesia has also offered some SOPs, with regard to saying, you could come in with your full cars, sell them with the promise that in 3 to 5 years you will set up manufacturing capability in the country, and quite a few of these companies have followed up. So this is kind of a diverse mix we want to leave you with to show that inflows are coming in, and each of the countries certainly has its own set of dynamics, and we want to highlight these 3 countries for a start. The second one, and the inescapable part, is about what's happening with Trump. In the past week, certainly we have seen I would think, a tamer version of the pronouncements. We did come in with a lot of fire and fury, and in the past week, it seems to have slowed down. We don't think that's completely, the risk of tariffs is not completely behind us. We still continue to see the risk, something that Asian policymakers, Asian governments will watch for very closely. And if you, as a starting point, try to track, which are the countries that are most at risk, and we just keep this pool to broadly Asia and a few of US, Europe, and you see that most of the countries tend to run a surplus with the US, or US runs a deficit with these countries, right? China's deficit has gone down with the US, but every other country has gone up. Again, this is compared in the past 5-6 years. So it's not surprising that in his own rhetoric, the US president has spoken about a few more countries, especially Europe, which has been coming up time and again. And from that point of view, I think 1st February will be important to watch, because some of the threats posed on China, threats posed on Mexico, Canada, might also get some direction by then. The other chart on the left, what is the intention to show this? I think what we want to show here is that ASEAN as a region, while its share in total exports in the world, while its share in selling a lot more to the US has gone up, on the other hand, quite a few of these countries are also running wider deficits with China. If you take 2000, 2010, even 2020 as a timeline, you in fact see the deficits have been high and have been going up, with a few exceptions, particularly Singapore. But otherwise, you've really seen deficits go up. So to mean that ASEAN-6 is buying a lot more, some perhaps intermediate goods, and then, of course, selling it to other parts of the world. And the third part in this section was to do with, in the next slide, which we wanted to just highlight the spillover risks. We did see that we're watching Trump 2.0 very closely. Not everybody is, can go scot-free. And while we do think that some countries in the region will be a bit more immune than the others, but nobody, I think, will escape, certainly. So we do see that the impact on growth, for example, could be anywhere as small as 15 basis points to 50 percentage points to about 50 percentage points, 0.5 percentage points. And the kind of the gradation or heat map that we show here shows which countries might be more affected and which less so. So there are countries like Philippines and Indonesia which are much more driven by domestic demand, and they stand a better chance of being able to withhold or withstand if there are any negative impacts, spillover impacts from a slowdown or more tariffs from the US on China, and then subsequent slowdown in China as well. We show here EIU study. This is, of course, not just the ASEAN markets. This is just markets on a whole. And I think I want to bring this up because we look a lot at trade and tariff. But if you take a risk score you expand that horizon to include trade, immigration, and security, then you will see that the mix kind of changes in terms of which are the countries that are close to the US and what would be their net impact. So this concludes the third part of our segment, and the fourth and the final one is the next, where we wanted to just highlight to you, bring out the policy implications. No conversation is complete without it. So could we take it? Yeah. So just the politics, what announcements will be made, and I think that's the part where there's still a bit of lack of clarity. And when we drill down to the monetary policy outlook for this region, I think on a whole, one can very comfortably say that inflation risks, the bulk of the inflation risks for the region are behind us. And when you compare, especially with the highs of 2022-23 to now and 2025, mostly inflation numbers are expected to be steady to slow, with a few exceptions, perhaps at a country like Thailand, where base effects might see inflation pick up a bit, but again, not very glaring. It's still under 2%. So inflation has been coming down. That has helped to push real rates up to positive territory. And you can see that again across the board, inflation real rates have turned clearly positive. But the fly in the ointment is certainly the what's happening to the currencies. And when we updated, in fact, if I'd shown you this a week back, you would see a lot more red on 2025. Thanks to the dollar correction that we have seen in the past week. In fact, most of the currencies are now faring better. And you can see kind of a mix. There are still few countries like, in Indonesian rupiah, currencies like Indonesian rupiah, Indian rupee, that are still red year to date. But there are some others who have really, especially the won, for instance, has made up on lost ground. What we want to, again, the takeaway here was that the monetary policy outlook or the monetary policy playbook for most of the region is quite comfortable. That they do have the space to cut rates if they wish to, right, or if they intend to. And in fact, you did see a couple of surprises, especially Bank Indonesia was one which was not expected to cut rates because of currency pressure, but went ahead to cut rates. So we do think that the path is diverging. I don't think any central bank Asian central bank is moving with the Fed 101. They are going on their own path, and timing is decided by financial stability risks. Now that inflation is behind us, provides them the headroom to become much more growth oriented. So they do look at, and I think they're going to be opportunistic and try and take advantage of the windows available to go ahead and cut rates. In the next slide, we wanted to bring about just a scenario building, right? Right now, there is considerable uncertainty on how much the Fed is going to itself do. So whether they're going to cut 50, they're not going to cut at all, and what is their interpretation of inflation risks. So we wanted to give out few scenarios, and our baseline assumption for Fed is that they're going to cut by 50 basis points, this year, and then push forward some easing to 2026. Now, going with that probability, we maintain our call, which I just mentioned, which is that the policy response regionally is going to diverge. Wherever growth risks become big, and FX is not really getting impacted too much, the central banks are going to go ahead and cut rates, as Bank Indonesia demonstrated earlier this month. And among the countries in ASEAN-6, we do think that BI and BSP are expected to cut rates. Singapore also eased, late last week, and I think Hanteng will probably touch upon that later. But the rest of the countries, we think they're going to stay on hold. They didn't really hike as much. And growth at this point, financial stability seems to be a bigger risk than growth, so they try and keep their ship steady on the monetary policy front. Then there is a scenario where Fed could be on extended pause. In fact, later this week the Fed meets, and we are of the view that the Fed is going to buy time. They're going to look at what's happening, what announcements come out of the US government, kind of weigh what it means for inflation, and then go ahead and probably consider easing in the middle of the year. But if we work with a scenario that Fed is not going to cut rates at all, and because of they're worried about inflationary risks, then certainly for the Asian central banks, currencies, financial stability will take priority. Even though growth might look a bit shaky, so they would want to keep maintain rate differentials, maintain, look attractive to the investor, to be able to, attract flows and keep their own balance of payments in check. So we would think that in this case, most of the central banks will tend to keep rates on hold for the rest of the year, even to the likes of BI, BSP. I think for BI in particular, if the rupiah really comes under pressure again, there would be a tendency to keep rates on hold. Right now, they have the room for another 25 at least, to support growth. And the third risk, which we see very low probability, but yet a risk that one should not wish away, is that Fed could hike. And this will really require a huge inflationary shock. All the pronouncements that the US president had said coming into power, what he says over the course of the next few weeks will matter a lot. And from that point of view, we would think that if that comes to pass, certainly not only a hold, depending on how much of risk builds up in the currency markets, some of the central banks might also consider, macro-prudential measures or wanting to tighten as well. So this brings us to the my last slide, I think, which would be the concluding. Okay, just the macro stability defense. Again, there is most of the countries in this region have very good buffers in place, by way of reserves, by way of lower short-term debt, and those ratios we track quite closely, and there's little to indicate that there are any pressures building up among the countries. So we wanted to take over to the next slide, which is basically to discuss the risks. And when we speak about that, I think there are a few that we'll be watching out quite closely, especially the new government and its trade implications. Very, clearly the risk that we'll need to watch. Commodity prices. Again, at this point, energy prices are at very non-threatening levels. So this is not a risk that really finds mention very often, but again, something to warrant, because quite a few countries are net importers. So it will become important to see where the commodity prices go. And just financial conditions in general, what comes out of the US becomes quite important. I think with this, I will conclude our part of the presentation. In the next slide, this is again, we leave this with you. This is an outlook report that our team had prepared with Bain and Angsana Council earlier in last year. And if you want to take a longer duration call on how ASEAN-6 countries are going to do, we do recommend reading this report, which has a great deal of detail. So in the next slide, then we want to conclude and just bring in the Q&A back. I do notice that there are some questions already in place, and we'll be happy if you want to ask any more that are pending. Let me just refresh that, and as Hanteng gets answering, I'll try and share my screen in terms of what the questions are. Hanteng, one of the questions, and I briefly touched upon it, was the bit on MAS. So one question that has come up is, were you surprised by what the MAS did last week? So if you want to take that first, please.
Yeah, thanks, Radhika. So that's a very timely question. So MAS is its policy last Friday by reducing the slope of the Sing dollar nominal effective exchange rate or SINGNIA policy band slightly. And I think just looking at the movements of the signia from the top of the policy band to the midpoint over the past couple of months have basically sort of priced in the expectations of such easing. I think two factors really stand out as to why MAS decided to ease. Firstly, we saw a low downward revision to its core inflation forecast for 2025 to 1 to 2%. Ours is already revised down to 1.5%. And this kind of means that inflation, core inflation in Singapore is going to be more benign in 2025 due to three reasons. I think fading impact of GST hike, contained imported inflation, and lastly, reduce domestic business cost pass through to consumer prices. I think the other factor that resulted MAS in easing was the fact that growth uncertainties are growing. I think in 2025, growth is early 2025, you would see growth being quite good, but I think uncertainties are growing going into the second half of 2025. And in that sense, MAS took a preemptive stance in easing policy. Going forward, what would they do? I think among the economists, the market expectations are kind of mixed. But from our perspective, we think that there was a dovish tilt in Friday's decision. And therefore, I think if any further easing might come in the second half when, geopolitical challenges might be more apparent.
Thank you so much, Hanting. I'm assuming you can see my screen, which has some of the questions. Thank you for taking that. So let me pick up one more, perhaps this one. Okay, we have a question which says, has DBS view on the dollar changed after the US president inauguration? Certainly something that's playing on everybody's mind. I think since late last year, when it became apparent that there's going to be a change in hand in terms of the leadership in the US, dollar has kind of benefited from that shift in expectations. And on the back of that, you saw a very sharp rally in the US dollar. Now, come the inauguration, lack of fireworks, especially on the tariff front, has kind of made investors sit back and think whether this is for good or we are going to see a sharp correction here. Something that happened back in 2017, soon after the new US president took over. 2017, in fact, saw quite a sharp US dollar correction. Now, in the context of the past week, our FX strategist has maintained in his daily writings that we don't think that this is a point of turn for the US dollar. That just because the risk of tariffs hasn't completely gone away. I think one of the things that the incoming government might be waiting for is the cabinet to get into place. The new president did sign a lot of executive orders, but some of these other tariff changes essentially needs your team also to be in place, which is underway, right? Some of the Senate confirmations are going on. So we do think that a clearer picture on tariffs will emerge when the team is in place. Plus the fact about rate and growth differentials being in favor of the US, I think is another thing that we think will keep the dollar bid. So, we don't think as a baseline expectations that what has happened in the past 1 week is an indication of what lies ahead over the next few months, at least. So to answer the question, we haven't materially changed our dollar view after the inauguration. Let me go back to the central. I think the key factors. Okay, let me take this one. This, I think for the benefit of the listeners, might be something interesting because most often the question asked is who is the most at risk. So interesting. Somebody's asked about, which country actually faced the least risk. Hanting, do you want to take a stab at that?
Yeah, thanks, Radhika. Actually, in fact, I think within ASEAN 6, the country that faced the least risk being targeted by the new US administration would be Singapore. I think Singapore first of all, is the only ASEAN country that has a FTA with the US. So that's one positive point. And then secondly, would be the fact that Singapore runs a trade deficit with the US, meaning importing more from the US than exporting compared to the other ASEAN-6 countries which run a trade surplus with the US. I think therefore that is also another factor that mitigates the risk. I think then thirdly, who are the major investors in Singapore? It is US, where they have set up you know manufacturing bases here. For example, I think last year Micron had even expanded their exposure here. So for the US, I think they have quite a lot of vested interest in Singapore, and therefore I think the US administration is therefore probably less likely to target Singapore, even though I must say that no ASEAN-6 countries are entirely immune, but just that on the spectrum of things which is least likely, and Singapore is one that I would come to my mind.
Thank you for that. Certainly an interesting perspective. Let me then go to, so we have answered most of this. In fact, I should have just X them out, but we have a question on Indonesia and try and let me take that. Indonesia President's 100 days in office. Not so long ago, and in fact, 2024 was one of those years when multiple countries had elections in the same time, same year. So Indonesia was one of them. Elections were held earlier in the year, but only in October, the new president took office. And what you did see is that he did with a very clear mandate, a big margin vis-a-vis his other competitors. And now we are, I think the 100 days have just passed. Has he met the expectations? Has the team met the expectations? I would think certainly in some sense it has, and some sense it's still work in progress. And anyway, 100 days is quite a quick, quite a short timeline to take stock. I would think where we have seen, the needs being met is what the president had mentioned during the campaign period, which is in terms of providing more, social assistance, especially some flagship programs, including free meals, for example. Now that program did see a bit of twists and turns in terms of the scope. Initial markets did react a bit adversely initially because there was an expectation that all of the budget will be geared towards all of the operational budget will be geared towards it in one go. They clarified it's going to be phased, it's not going to be, it's gradual, so that not to put so much fiscal pressure. But yes, in some form, that program has taken off. At the same time, I think the other bit that stands out is the president's efforts to actually make Indonesia much more part of the global order. They're going to have mentioned about joining the BRICS group. They are also, the president has been traveling far and wide. In fact, just yesterday he was in India on being invited as a chief guest for India's Republic Day. So he has met various counterparts, and I think that kind of cements Indonesia's interest and role in wanting to attract a lot more FDI into the country, kind of draw deep linkages on the trade front as well. Where we think it's a work in progress, I think on the fiscal front, last year's fiscal deficit actually came in less than what was expected. Means it was narrower, which is a good signal. But there's much interest in seeing how 2025 goes, because the spending needs are still there. Revenue is, increase is in question, especially because there was a 1% increase in the VAT that was supposed to come to pass but didn't. It has been deferred. So that is where I think much of the focus lies in terms of fiscal performance, because growth really needs a hand. Growth has been softening, especially on the domestic demand side. So it would be great, if the fiscal policy could lend a hand. Monetary policy is doing its bit, but fiscal policy as well. So I would think here there's still, work that is still going on, and we would generally think that more would come to pass in the coming months, just taking stock of the first 100 days. I think with this, the time is 5 p.m. here in Singapore. We want to thank you all for joining this call. Thank you so much for spending your afternoon with us. And if there are any questions thereafter, please do feel free to reach out to Hunting, myself, or anyone in the team, particularly if it's any specific geography in question. Thanks again, and look forward to seeing you all in the next webinar. Thank you very much.